Hello, welcome to today's Advisor Q&A. I'm Tony Cohen, the editor of InvestSMART, and I'm joined by financial advisors Bruce Bramall.
Hi Tony, how you going?
Good. And Max Noonan.
Tony.
Our regular duo in the Advisor Q&A sessions. Now today
Dynamic duo would be a good way
Dynamic duo, of course. Now, we're going to go back to the property subject again today because there's just so much going on and it warrants it. Plus, we're still getting questions around the downsizing legislation coming in later this year or from mid-year. And then just in the last little while, we've had some rumblings in terms of franking credits and imputation. And we should talk about that because there's an implication there around property as well. So we'll get to that a bit later. But perhaps we can just sort of rehash for people listening in today just what's going on in terms of the downsizing legislation and plus some of the other things which have implications for property inside SMSFs versus outside SMSFs, which I think people want to know about.
Yeah. Do you want the basics of this downsizing?
Yeah, let's go over the basics, Max.
It doesn't apply to any sales until after July 1. So if anyone is looking at selling their home and they have the ability to possibly use some of those proceeds to go into superannuation, and when we say sale, it's date of contract, not date of settlement. So the actual sale, the signing of the legal documents, has to be July 1 or after. The house must have been lived in and for 10 years. The house must be eligible for the principal place of residence exemption, the main residence exemption. It doesn't apply to transportable homes. Doesn't apply to houseboats, doesn't apply to mobile homes and those sorts of things. The proceeds of the sale must go into the superannuation fund within 90 days, I believe, of settlement. And the amount that can go in is limited to the maximum of $300,000 or the proceeds from the house.
300,000 per person.
Per person.
Yeah. So 600,000 potentially for a couple.
So if you end up selling for $1 million, buying for 600, the maximum you can get in is 400.
No.
Yes, because you sell for $1 million.
Yeah.
You buy for 600. If you haven't got any other cash sitting around, the maximum you can put is 400.
Oh, but you could load up on gearing on that.
Oh, yeah,
there's no restriction.
But
there's actually no restriction on you having to buy again.
No. In simple terms, traditionally, unless people want to end up renting, which at that stage of life I couldn't see being all that clever. But what does make sense though, for someone who wants to end up maximising, and if they have investments other than their home, they would be selling those at roughly the same time as that they've sold their home. So some of the cost of going into the new accommodation, and it could be that they've sold their home for $1 million, they buy a new home for 1.5, but they've been able to end up having $1 million worth of investments they've sold. In the end, you can't end up having more than what's coming from the proceeds.
Correct.
Of it.
Yeah, but I think as we talked about last time, Tony, there's no downsizing requirements. No. There's no actual requirement to buy again. So you could do that. You could sell your $1 million home, buy a $3 million home. If you've got the cash lying around to put in potentially two lots of $300,000, then you can do that. So it requires you to have the cash to be able to put the money in, obviously. But there's no requirements to buy to actually downsize to a property of lesser value, or even to purchase any property at all. And in fact, you can upsize. The rules haven't been put in to say that the value of the property that you purchase after the making a downsizer sale has to be of any particular value or less or more or whatever else it is. So if you do have enough cash lying around, you can put in.
Well, and you make a good point too, Bruce, that you'd have to do the numbers, which always comes back to dollars and cents and tax. And the other thing that would need to be factored into this is Centrelink conditions or provisions, because it could make sense in some circumstances for someone to borrow for the new place, especially if they're locking in an interest rate of 4 or 5% or something like that, and they know that they can be earning 6 or 7% in the super fund, which is going to be tax-free, it's not going to be a huge arbitrage, but it could make sense, especially if they know there's something else coming up from a point of view of maybe an investment that is got a longer maturity date, like it could end up being term deposit or something like that, that they could end up having the borrowing, maximise the 600,000 that's going in, and have that debt paid off later. So it's going to open up a whole new area of strategic options that are going to be very valuable.
I just thought of another one, which others probably had, but I hadn't put as much thought. You could sell $1 million home. You actually have $2 million in cash lying around, which is making you not be able to get a Centrelink benefit. Put your 600 in, leaving you 2.4. Take away stamp duty. You could buy a 2.2 million house. That could be your only assets. You could actually go from having $3 million worth of assets to having get yourself under the Centrelink's Centrelink tests. Assets and income.
And that's an important thing to raise, the assets test, and how this can play into that, because if you do it, I won't say it's the wrong way, but it can have implications for getting your pension.
Well, that would be great too, Bruce, because we might actually have some Australians buying high price rather than overseas people, because they'll be, I don't know.
I don't think that the example I just used would be brilliant, because 600 would
I don't
most
have
likely
$2
take you
million
over.
of cash lying around, Bruce.
Not all of us do.
No, I know you might, but
I don't know where to find it if I do.
Okay.
That's right.
But
I know a few
there's some interesting
backyards
things.
where I've got some clients that I think they've hidden some stuff, but that's about all. That's it.
the other part of this is that I believe the contribution into your super from the proceeds, or into your if it's a couple, into both of your super, works separately to the other laws.
They've created a new type of super contribution. We've got concessional, which are the tax deductible contributions, whether they be by an employer or self-employed or a personal. You've got the non-concessional, which used to be called undeducted, which is the after-tax contributions. You've got the small business capital gains tax relief contributions is the third one, and now we've got the fourth one, which is the downsizer contribution. Both the small business and the downsizer contribution is not affected by any of the caps that are being brought in from a point of view of the 1.6 new reasonable benefit, the transfer balance cap.
And certainly the downsizer one is open to people of any age. So concessional and non-concessional contributions you can't make beyond age 74, 75. The 300,000 for the downsizer can be made anytime you sell a house.
As long as you're 65. That's the only thing.
You've got to be over 65,
which is interesting the way they've targeted it, because this has been the problem. If you're 65 and retired and didn't really want to go back to work at the local McDonald's to meet the work test, if you came into some sort of a windfall, the money couldn't go back into superannuation. So they've specifically targeted it at that area where people have not been able to get the money into superannuation, but as a result of this will be able to, and they're not affected by any of the other limits and things like that.
Another thing to talk about is the ownership, 10 years, but if you're in a relationship where one part of the relationship has owned it for 10 years and you're newer on the scene, so to speak.
Yes.
Let's say
tabletop dancer one day, wife the next, anything like that.
Anything like that.
Yeah.
It doesn't apply to that person. So in effect, they get the full benefit of the 10 years ownership.
It goes to the couple. Yeah. And as long as one member of the couple have lived in the home for 10 years, it doesn't translate. In fact, you can have a situation where you have a couple, the couple have been married for 2 years, one of the members of the couple have been in the house for more than 10 years, one of them dies, and the one who has only been in the house for 2 years gets the benefit of the ownership of the deceased partner. So therefore, they've been very generous in interpreting this 10-year rule. One of the worries about before we saw the whites of their eyes, the black and white of the legislation, was how restrictive they were going to make this. But they have bordered on being generous with who can actually get it from a point of view of the whether they've been living in the house or not. Because, I mean, one of the things that worried me when they were talking about this, if you've got someone who's a professional and is at risk at being sued, it's not unusual for the house to be in the other person's name. I was worried, well, if only the person who owns it, whose name the property's in, can get it, well, that wouldn't have been as good as if it hadn't have been that situation. So that worry has been taken off the table.
Before we get to questions, my question is, have you been getting a lot of interest from your clients around the downsizing?
Not yet, because I think it's been more the other thing. If clients have ended up saying, we're thinking of selling, I said, well, hold on a sec. If you're thinking of selling, do you realise that if you delay selling for 4 months, you then could become eligible for the downsizer? And in some cases, that's not going to. I mean, I had some clients in yesterday. They're looking at going into a retirement village. And in checking through with them, unfortunately, the 10 years aren't up until 2020. I said, well, look, if you've got to go in there, and they don't, it's actually a decision they're making before they actually are forced to go into some sort of retirement village. I said, well, you need to have at the back of your mind, unless there's something that really comes up that you'd be crazy not to take it. Now, have in the back of your mind that if you did delay, because we've worked out there's about a $200,000 or $300,000 difference. In fact, that was even about $400,000 or $500,000 difference between what they get for their house and what the deposit would be in the retirement home. Say, you could put it off to then. That was a bit too far off in the future for them, but it's something that's more coming up in the language, and any professional who's providing advice that's not alerting their clients to that, is certainly not doing their clients a service.
Mm. And what about you, Bruce? You've been getting much interest out of this?
No, I'm speaking to people about it as it comes up, but I haven't had anybody who is making that decision just yet, and it could just be nobody's looking to sell in that category that I've seen since they've made the announcement. But as we went through last time, this isn't going to suit everybody. It's not going to work for everyone, but it is for those that it will work for, is going to be a significant boost to their super, particularly those over 65 who can't make further contributions to super, who'd like to, who were thinking about selling their house anyway or downsizing anyway. I mean, this is a big handout.
Yeah, maybe it's just a case of the legislation coming into effect, and then it'll get some traction then.
I know it's something that I'm going to be trying to be a bit proactive. Unfortunately, I sometimes suspect that letters from your accountant ends up being put in the bin without being read, but I'm going to get something out to my clients, especially those that are 60 and over, to say, hey, you need to be aware of this new benefit. Who knows, depending on the level of craziness of any new people in Canberra, as to how long it's going to continue. But it's something you need to now take into account in future going forward.
I've got a few questions on the board here, but I would say to people tuning in today, if you do have any questions for Bruce and Max, now's the time to ask them. So go onto your panel, which is on your screen. There's a little section there to ask a question, and send that in, and we'll get to it as soon as we can.
Before you went to questions, Tony, did you want to go on to imputation
credits? We can certainly go into the imputation discussion. It's still, obviously, the dust is still flying around on that. Who knows? Anything can happen in the next few weeks, or even sooner. There's a lot of pressure on the ALP, and particularly Bill Shorten, to reconsider what he's suggesting. But let's just have a quick chat about it. You wrote about it yesterday, Bruce.
Yeah, so a column for readers if they want to have a look at it. But one of the interesting things that comes out of it is, given that we're talking about property today, is that the general feeling is that if pressure is put on, or some of the benefits are taken away from imputation credits, that people will start to look elsewhere for returns that are not going to be taxed at the company tax rate before it comes into their hands. And two of those are going to be property, two or three of those, property, listed property trust or REITs, and bonds, for example. They're three asset classes that won't be, you don't generally receive income that's been taxed at the company rate before it gets to you. So this is just, it's one of those decisions that if it does go ahead, and that requires the APO to win the next election and to be able to get it through Parliament, where it could actually be another force that gives some small push up to property prices, good or bad, not my call, but it is something that could put further pressure on house prices in an upwards direction.
Well, let's just, while we're on the subject, let's just briefly explain exactly what is being proposed here.
From a tax point of view?
From the tax point of view.
And it's interesting, I thought you were generous saying it was a rumble. To me, it's a insanity, and it's also, it becomes another retrospective change, because lots of Australians have made choices to invest in listed shares due to the imputation system. And basically the imputation system is when you get a dividend from a listed company, that it comes with a tax credit. Now the tax credit can be used to reduce the tax payable on the dividend received or creates a refund. For example, company's made $100 profit, pays 30 cents in 30%, so $30 in tax, so we've got $70 left. The $70 gets distributed to a shareholder. The shareholder must show on their tax return $70 as income received plus the 30% tax credit. Right? So they've got $100 that they're paying tax on. If their marginal tax rate is, including Medicare levy, 34.5%, they're paying an extra 4.5%. If it's 39%, it's an extra 9%, and if it's the top tax rate, they're paying an extra 17%. If they're paying less than the middle tax rate, if they're paying 21% or they're not taxable at all, they get a refund. And so if they're not taxable in that situation, they get a $30 refund.
And now, that's where we're talking about retirees.
Yeah, but it's different from that. And this, I mean, if I was a conspiracy theorist, I'd end up saying it's another attack by Labor, who have always been firmly on the side of industry super funds, who I'm a big fan of, against self-managed super funds. Because from my understanding, the way the big super funds work, they get these masses of franking credits in and they allocate them across all of the taxation that's payable. It's not as targeted or specific as if you've got a self-managed super fund and it's totally in pension phase, the superannuation fund gets the credit of those imputation credits, like in that instance, the $30, and so therefore it effectively increases the income that's going to be there to help to be generated to pay the pensions. Self-managed super funds will be a big loser. Who else will be a big loser is people who have superannuation that's tax-free as a pension, and they've invested some of their money outside to help with that. And the other interesting, you're talking about an asset class, that's going to raise the attractiveness of the unlisted direct property trusts that can come through with anywhere from an 80%, I mean, in some cases they have zero, but they have this tax deferred income. So you could be receiving $100 and it's 40% tax deferred and you only pay tax on $60. So I think it's very badly thought through, which I mean is surprising for Labor. But you know, it's something that it could end up being a deal breaker for lots of people, as far as Labor and Shorten goes.
You can see what they've tried to do with it. There are some very large super funds who are investing in and getting very large sums in fully franked dividends and then being able to claim the whole lot back in tax. But there are going to be a heck of a lot of people who, in the example I used in the column the other day, that might get the full pension because they're only getting $10,000 worth of income a year, $10,000 fully franked income a year, which translates into roughly 14,000 something or other, 14,500. They will lose that. The $4,500 to somebody who has outside of their pension income only $10,000. That's going to be a very significant amount of money for them. That's not going to be everybody. There's going to be significant numbers of people. I would probably think tens of thousands of people who are going to be in that situation, who are going to lose an amount of money of probably several $1,000s because you won't be able to claim back excess imputation credits anymore.
It's I think it's going to be even more. I think you're going to be talking in the hundreds of thousands because, being at the tax coalface, you can have people that are getting, in some cases, small taxable, like they can be on the age pension, or they might be getting some other income. They may be getting a pension from the UK. Or wherever else, and there's a lot of people here that get the pensions from the overseas, the Dutch. So there's a lot of that. And given that someone who's over 65, after you take into account the low income offset and the seniors and pensioners tax offset, they can earn up to about 26,000. So there will be a lot of people who might have a Telstra share, they might have a CBA share. They've got a very small share portfolio, but what they used to get as a little bit of extra to help them, make ends meet, that's going to go, and it's lies, damn lies, and statistics, and what comes out of politicians' mouth as a bad fourth, because it's not going to be this so-called taxing the rich and supposedly helping the middle class. The very low-income people and the middle class, who are a big investor in this stuff, are the ones that are going to end up being affected.
Yeah, I mean, there's all sorts of ramifications for this. The assets test changes that came into effect last year. Some people may have had a property, an investment property, which was generating, very low returns, as they do. To get within the assets test, they've sold that property. They may have put some money into their house and kept a bit on the side, and then so that bit they've kept on the side could be impacted by this law.
If they've gone into the shares too.
Yeah,
I mean, you can't beat the fact that, I said it before, there's a huge amount of retrospectivity to this. People have made decisions to buy shares over a long time, and suddenly, bang, tax rules have changed. I mean, when they brought in capital gains tax, anyone that have brought the properties or investments before September 1985 didn't get affected. In this case, it's another one of these. And this is a dangerous trend that seems to be fitting in. Both parties are guilty of this, of bringing in legislation that has a major retrospectivity. I agree, they're going to maybe have to do something, and it's interesting when you look at the coalition's policy to reduce company tax rates down to 25%, is effectively going to be helping solve some of this problem, because when the franking credit comes down to 25%, there's going to be less of the money going back to shareholders. So very much a watch this space.
Very much so. We'll get back onto topic, but everything's fair game when we're in the room together.
That's right. I mean, it was the elephant in the room, whether we like it or not.
Oh, we have to talk about it, and it does have implications for property.
Yeah.
All right. So I'll get on to questions again. If you do have any questions, now is the time to ask them, because we won't be sitting here all day, but we're very keen to answer your questions.
And can I add that to Tony? Don't forget the questions that come through that I answer through my column. If something occurs to you and you didn't get a chance to put it in for today's webinar, get them sent in so that they can be answered that way too.
Okay, thanks, Max. All right, so the first question is from Jim, who's 56, intends to retire at age 60. 2 investment properties in addition to his principal place of residence. One will realise a net gain of about 300,000, the other about 700,000. In addition, he has $1 million in super at this point. Would it make sense to keep these properties outside of a super, or to sell them in the next few years and roll some of that money into his own super fund as non-concessional contributions?
There's a few things that he's going to need some personal advice on. We can't give a direct answer on that one. How much tax is he going to pay? Saying we'll get $300,000 out of it, but we have no idea what the profit is on the property. Is it $300,000 because he's paid the loan down? Is it $300,000 as a profit? What you need to sit down and figure out is exactly what sort of tax, capital gains tax you'll pay, the costs of selling, two of the big ones on the sale side. Then if you can get the money into super, great. He's 56, turning 60 in a few years. He's got at least sort of 8, maybe 9 years of being able to put in money at $100,000 a year as non-concessional contributions into super. If he's married, double that sort of figure, 3-year pull forward. You can do 300,000, 600,000 for a couple. There's a lot of very interesting financial planning, financial advice work in there, but you need to sit down and go through your situation on that one and figure out the specifics, the costs of selling, the benefits of getting the money into super. Will those benefits outweigh the costs of the sale? Or the sales, if he's looking to potentially sell both, and over what period that's going to, the payoff would come in earning income taxed at 15% until he turns on the pension, versus, pardon me, whether he's going to bust his $1.6 million cap. He's already got $1 million in super, so there's a lot of moving parts to that question. And sitting down to work it out with somebody specifically to go through and have a look at the proceed as planned option, or the let's do some proper planning to see where we go here. It could be the difference of tens of thousands of dollars to him, but yeah, we'll need to sit down and work on that one.
I agree with Bruce. Jim needs to get some strategic tax and retirement planning done, but there are some tax facts that are pertinent here. He would not sell the properties while he's still working. It doesn't make also a great deal of sense to keep the properties, given that probably if he looks at the net return that they're generating in an income, you'd be lucky if it's a residential property to be getting better than 2.5%. So first thing is, you wouldn't sell the properties until ceased working, which means therefore the chances are the income he's getting is from his million in super and it's tax-free, means zero income. That means when the capital gain is made, he's making use of all of the zero income tax rate, and all the way up through to the top tax rate. But it also means he's doing it under 65. He can make the $25,000 personal tax deductible contribution. So that effectively means on 50,000 of the capital gain, after taking into account the 50% discount, he's only paying 15% on the 50,000. So a couple of things there that go without saying. The only other thing that he might want to bring into this is that if one of the sales is happening closer to 65, and one of the questions I ask my clients doing a strategic tax and retirement plan is, do you plan to be carried out of your home in a pine box? If the chances are that they're going to be wanting to go somewhere else, to therefore factor in the downsizing, that one of the sales could be timed so that, and it doesn't have to be a downsizing, it might be the upsizing, as you said, but if the plan is that they're going to be moving somewhere else, is that they end up having the sale of their home take place after they're 65. They've got the cash that's come through from a rental property, which means they've got an extra 600,000 that can go in, and forget about the 1.6 because it doesn't apply. So there is a wealth of stuff that Jim needs to be considering, and to do it properly, he's really got to see a professional.
And there's another assumption that I'm guilty of having made, and Max is guilty of just having made, is one of these assets might be a pre-CGT asset. So
no, Jim's too young for that, mate. 85? If he's 51 now?
Oh,
56?
30
I'm not
years.
sure.
Well,
You might have bought a property young.
Unlikely,
Okay,
but
well,
it's a
I mean,
possibility. If
yeah.
it was a pre-CGT asset and there's no tax to be paid, then it doesn't
Yeah,
matter.
you're right.
Wait until you finish work, and
And that's why it's important that everything gets looked at.
needs advice. Yeah.
Definitely needs advice.
But what you were just saying, Max, it makes, on the surface it makes sense not to do anything until he retires.
No, not necessarily.
No. Just
Speak
he
to
needs to
somebody
get
now.
the plan done now.
Oh,
And if he's going to speak to a planner, right, an advisor, and I'm being prejudicial here, but there are several questions that he needs to ask the potential person. Is that, was this person ever an advisor that used to receive commissions? If they were, needs to be careful about where the advice is going to go. I mean, the number of people, I had a phone call from someone yesterday who's got about two super funds outside of an industry fund. The other two are in commercial super funds. And why the advisor hasn't years ago said, well, why don't you consolidate everything and you'll end up saving money? Because that advisor's still getting trailing commissions. So you've got to make sure that the person you're getting the advice from hasn't had that situation where, and that's why they brought in the FOFA reforms, they had to do that because there were so many advisors out there that were more intent in making themselves an income stream rather than really benefiting the client. So you definitely must get that advice.
Okay. Well, we'll move on to the next one, which relates to what we were talking about on the Labor proposal on cash refunds for dividends. This is from Harry. Harry's saying, is it really better to have retirement funds invested in the properties instead of shares? What are the tax implications moving from a tax-free environment in retirement to a taxable one on, say, a property generating $30,000 a year in rental income? I'm single, retired, have $600,000 in an account-based pension, and $500,000 of this is invested into Australian equities that receive dividend franking credits.
You've got to look at the total return.
Yeah.
And see, the interesting thing is, again, the 600,000, there'd have to be probably some borrowing there, and you can't get beyond if it's a residential property.
Was it a property? I thought it was 600,000.
No, but he's talking about buying a property.
Buying a property.
So if he's buying a property, you're going to be talking about 2.5% to 3% income return. Why would you do that when you can get into the unlisted direct property market where they're paying between 6 and 7.5% with some capital gain? Yes, there's a risk that there can be not as good a gain because, and that's the other thing about residential property. Residential property is great when you're in accumulation phase, when you are trying to maximise the retirement assets you're going to have for retirement purposes. Residential property is great because the gain doesn't come from the income, it comes from the increase in value. If you're in retirement, going in backwards into that residential property could be a very bad move because it's hard to take boards off the side of the house and some sheet off iron off the house to make ends meet when you've not got enough income coming in.
Yeah. What specifically what Max is talking about there and what we've spoken about in the past is that you have to pay yourself a minimum pension. And that minimum pension has to be 4 or 5% and increasing as you age, which can be very difficult to do if the property is the main asset of your super fund, as in 500 of a $600,000 fund, 500,000 property out of with another $100,000 worth of assets. If you're in pension phase, you've got to pay a minimum of 4%, maybe 5, 6, 7, etc. Being able to meet those pension requirements ongoing into the future when you have one property as the major portion of the fund, you will eventually get to a point where the income being generated by the property is not going to be sufficient to be able to pay your pension. If you're going to get to that stage into your 60s and your 70s and you want to own property, then you need to have a lot of assets outside of that property, liquid assets, that will allow you to continue to pay an increasing pension over time.
Okay. Just bear with me, I'm just having a...
Seniors moment? No?
No, not yet, Max.
That's all right, I have them all the time. So
to go further into that question, though, would you sell your $500,000 worth of equities to go into property? Depending on your age, probably not. I thought there was some hint that they were talking about pulling it out of super to buy property outside of super, which probably isn't going to.
Well, that's the implication in question, to take it out of super.
Well, once it's in super, it's too hard to get back in, and it'd be very hard to get the same benefits. I'd be worried if all of that super fund is in equities, because I had another client this week who they had about effectively 70 to 80% in equities, and they were retired. And I said, look, you may have a great you're not scared of the risks, and you like the share investment. But it was very hard to let to remind clients know of the risks of the equities, and refer back to the Great Depression and the massive Wall Street crash. But since we've had the GFC, when you've got 80 or 70% of your superannuation fund in the share market side of things, and if there was a 30% correction, you're talking about it takes a while to get back from that. I'd be saying this reader should get some advice on some portfolio construction too, because it's a very brave decision, because there were many people before 2007 who thought that share market was 100% safe and I'm never going to lose money. Now, there are a lot of people who found out that they had to go back to work, because not only had their super funds dropped by anywhere between 30 and 40%, but the income that was coming in because of the recession dried up and they had to go back to work. So definitely it's a very, very brave decision to have all of your super fund in shares if you're retired. Different thing when you're in accumulation and you can get the benefit from putting contributions in after the share market's crashed, and you're not going to. But no, very, very brave.
All right, well, let's keep moving on with the questions. Got a question here from Linda, who's looking to take advantage of the downsizing legislation. I think we covered this off before, but Linda's saying she was looking to list her home in May this year with a view to a 90-day settlement, which would take it through to August. Can she still take advantage of the downsizing legislation, or is it best to wait till after June 30? And
she can list it, but she cannot sign a sale document till after July 1. So list it and put on a really big high price, and can hang on until the buyer comes after the July 1. But no,
more than likely you'd delay putting it on the market, I would think, for a little while, because if somebody wants to buy urgently, they're not you're not going to be able to sign anything if getting this using the downsizer legislation to get money into super.
And I think they need to get some advice, because you can't look at this in isolation as to okay, if all of the money you're going to produce from that's going to go into a new replacement house, well, there's no point worrying about it. So there needs to be more analysis done of what the whole of the financial resources this person has to be able to work out, even is there going to be the ability to get the 300,000 or 600,000 depending on what the rest of their plans are. Very hard question to answer in isolation.
I've got a question from Gavin, which really goes to the whole heart of the issue around whether it's better to have a property in your super or outside of your super, which I know you've both written about in the past. But Gavin's saying, look, the laws have changed, the lending rules have changed around borrowing, inside a super fund. Then you've got the total super balance rules that have come into effect. What's your view really in terms of, whether it's better to have a property inside super versus outside super in light of all these changes that have come into effect?
I love property as an investment. Until 2007, when they changed the rules, it became very difficult. It was very difficult to buy a property in super, because you needed to have a cash and you couldn't borrow to buy the asset. If you understand property, if you know how property works and are comfortable with the cash flows surrounding property, then having a property inside a self-managed super fund can be a wonderful idea, again, probably for younger people rather than older people who've got time on their side to allow property to work, but being able to defer the real gains of an investment in property, which is the capital gains made out of it, rather than the ongoing income. If you're able to delay that or property helps you, delay that gain for a number of years or decades potentially, and if you're able to purchase a property that you're then not selling until your fund is in pension phase, then there's no tax to pay on it. So property can still be a very powerful, and geared property can be a very powerful means of wealth creation inside super. It can just as equally be a very solid way of making a good pot of money outside of super, but they're two very, very different strategies. One, the tax deductions inside a super fund ongoing aren't enormous, but you can essentially make your fund become a fund paying zero tax because of the negative gearing, but potentially offsetting your contributions tax, with the knowledge or the planning that you're going to be selling this asset potentially when you're in pension phase and not paying any tax on the capital gains. Versus outside of super, wonderful tax deductions potentially ongoing in the early years if it is negatively geared, with a lot of with significant borrowings against it. The downside of that is that when you do go to sell it at some stage, it will be fully taxable. And even if you have no other taxable income after age 65 and retired, any gain that you make from property is going to take you into the realm of having to pay capital gains tax. So there are benefits of both. For many people, doing both will make a lot of sense. I think it's really important, I've written this a number of times, that if you're going to invest in geared property inside a super fund, that you have either experience with geared property outside of a super fund in your personal name, or you've run a business or something, so that you understand how different doing a geared property inside super can be. But they're both potentially great investments. For some people, one over the other would be a preference, but there'll be a lot of people out there as well who are happy with the property gearing that they've been doing in their personal name for a number of years, who want to replicate a portion of that inside a super fund. And for many of them, that will be the right thing to do. For a whole bunch, it won't be, but potentially it's a very good way of generating a pot of assets inside a super fund.
It's a real case-by-case basis, and I agree with Bruce. And I actually, after we'd had a little bit of a discussion quite a few months ago, and because you were saying
convincing.
How great, it was convincing.
I was convincing.
Well, you were, because really, when you hold the property in the super fund, up to a point when the super fund is paying a pension and it's now then tax-free, it's almost a no-brainer. But then at that point, you do need to recognise that you should be thinking about selling that property for all of the other reasons with one of the previous questions we're talking about. Keeping that as a property inside the super fund when you're in drawdown phase doesn't make a lot of sense.
Unless you have significant assets and whatever other cash that's come into the fund, you've used to purchase other assets that are more.
But even then, I still think if you look at it, in retirement, you need return to help fund the pension that's got to come out. If you have sufficient income coming out to fund the pension, you don't get as affected in the event of an economic or share market downturn. It's the people who got hurt in the GFC was where there wasn't sufficient income coming in and they needed to have money for living purposes, and they were forced to sell assets. Whenever you're forced to sell assets, you will end up making a loss, inevitably. So therefore, keeping that property in there, given that when you look at the income that's produced from one of those, you've still got to run the numbers. So yes, definitely if you're going to be keeping the property in until the super fund's paying a pension as tax-free, very worthwhile. If there's a chance that that's not going to be the case and running the numbers, when you look at the tax benefits going through depending on a person's marginal rate of tax, if the property is going to be sold in the super fund when it's not in pension phase, it's a 50-50 phone a friend option sometimes. So, and in fact, sometimes you can have, depending on the higher marginal rate, you can be better off. So,
all right. We'll move on to John, which is a question around downsizing again. John's got a property. What are the rules around subdividing his principal place of residence and building 2 townhouses, selling one and directing money into his super that way? Is that allowed?
I don't think he would meet the 10-year rule. If they're serious about this, and sometimes it can make more sense from the point of view of maximising capital gains and the tax benefits, is that if the property can be subdivided, with the existing residents staying there. That the townhouse gets built in the back, that the front house is sold off, that in that case they would meet the 10-year rule, and that would give them the opportunity to get the money into superannuation. I'm worried that, and then in that case they're selling one principal place of residence, no capital gains tax. They move into the townhouse in the back and then live in that for a while, and you can't, there's a general misconception, I only have to live in a house for 3 months and it's my principal place of residence. The tax office can see a pattern of people doing that. Well, it's no longer the principal place of residence, a way of creating capital gains, and they'd get hit by Division 7A. But in that case, if they wanted to get the benefits of possibly the downsizer contribution and the maximising their capital gains tax benefits, sell the existing house, build the unit out the back. If they end up demolishing the existing house, they're going to end up having a total capital gain on the part of the property for the unit that they're selling, or the townhouse that they're selling. They're also going to have to register for GST, and 1/11 of the value of the property that they're getting for it will go. Again, in these cases, whoever's ever considering this, they need to get professional advice, because there are so many traps. I had a doctor client who thought, buying places, subdividing, building units was a great way to make money. That was great until the GFC hit, and then the bank started to force him to sell things, and he suddenly realised, I should have been registered for GST, and it ruined him. So you have to take account of all of the taxes, not just income tax, not being able to get money into super, but the GST can really come back and bite you on the posterior if you're not careful.
Another question here from Paul V. We have answered it, but Paul's 61, relying on his solely on his pension from his self-managed super fund. But in terms of the downsizing legislation, he's asking, do I have to be over 65? I think that's pretty black and white.
No wiggle room that I like to work in. No, just black and white in that one.
Yep. Okay. All right. Well, that brings us for the moment to the end of our normal questions. Did we want to just sum up, guys, in terms of the environment around property inside and outside of super funds? So we were just talking about that. So obviously it depends on your personal circumstances.
It really does, but it's also now, as a result of the downsizer, making it even more important to get the advice, especially in relation to that person, Jim, was it, who had the 2 rental properties and this sort of thing. And I alluded to the fact that one of the questions I always ask clients, do you plan to be, picked up by the hearse from the property? And the other thing I like to raise with clients too is, look, you've also got to look ahead to the possible situation where you may not be able to stay there. If one of the couple, for dementia purposes or any other purposes, can no longer stay in the home, that could be the deal breaker of staying there, and at that point that they have to go and find a retirement village, a nursing home or whatever. It's best, as in like most things, that all of this is planned for. So from a point of view of for clients, especially in their 40s and 50s, you ask the question, do you plan to live here forever? And they say, well, no, it's our big family home. By the time we've retired, we're probably going to want to end up maybe having a sea or a tree change and stuff like this. That it's important then, especially if they're in good income earning time of their life, to say, well, you should think seriously about looking around where you'd like to maybe retire to. Find a property that you'll know that you're getting at a reasonable value now. You gear that property, get the benefits for the rest of your working life of the tax deductions, and then once you retire, you end up getting the benefit of having a place that you've purchased at today's dollar value. In 15 years' time, the value of your house should have gone up. At the worst, you'd hope it's stagnated, and the loan that you've taken out for the rental property will have stayed the same. So you end up having that ability to sell your house, capital gains tax-free gain, pays off the loan on the rental property, and which even increases the possibility of bringing in the downsizer situation where that they now have, they might be 65 when this has happened, would not normally, and maybe they've even got more than 1.6 million in super. They wouldn't have normally been able to get some extra money into super at that stage. They can use the excess cash from the strategy to go into super. So it's raising some other interesting alternatives for people. And whenever I talk to clients about this planning sort of stuff, unfortunately for too many people, their journey to retirement is similar to jumping out into the vehicle in the front yard, driving off, and then they end up in a place called retirement. I know whenever I'm going on a trip, I like to know where I'm going first. And the important thing is to work through what that is. And you don't have to end up sticking to that and doing that rental property. I mean, I personal experience, I think it was great to be spending 3 months of the year in Queensland. So I bought a property up there and then suddenly realised, no, I don't think it's a good idea, but it ended up being a great financial investment because there are two types of property investments: pure financial investment, and the other one is a personal financial investment, lifestyle. So,
look, my thing, Tony, is that I love working with people in their 30s, 40s, early 50s. It's that sort of age bracket that is about, in my opinion, accumulating as many quality assets as you can. Property and shares are amongst those the sorts of assets that you can be. That you should be accumulating. And if you've got the time and the inclination, the drive, the will, the ability to make the sacrifice in your 30s and 40s to do that, you should be. Yes, you've got a big mortgage and you've got kids to get through school and raise in general. But during that period of your 30s and 40s, accumulating quality assets is really important. And one of those is property. The other one is shares. But being able to manage and purchase those, there are tax benefits potentially along the way for negatively geared property as it stands today, and may be different after the next election. But certainly the rules that apply today can make that sort of accumulation of assets, those sorts of assets, worthwhile. Sometimes it makes sense to do the same sorts of strategies inside super, but what people should be working towards is accumulating quality assets through that period to be able to give them the options in their later 50s, 60s and 70s. And that's what we enjoy working with people to do, and to give them the advice around so that they get to that point down the track.
Okay. We'll leave it there today.
Is there another question come through?
No, all good.
Because I think one of the things that needs to be looked at this too, and this next federal election that comes up, there's going to be some very clear lines, because you've touched on a couple of things, Bruce. If Labor continues with the policies that they've announced, there's some significant policies in there that are going to affect a lot of Australians and their retirement planning. One is the removal of the ability to get a refund for franking credits. The other one is the tightening of the negative gearing side of things. I think that you're only going to get it on and then the other one is the taxing of family trusts income. So
and also potential reduction in the CGT discount.
That's right. So there's a lot of things that are shaping up. You can see why they're doing it, and they've got a very convincing argument. We can't keep on going down the American route where we can't afford to pay the government benefits because we're not getting the income in. But there needs to be alternatives, I think, to it's the sledgehammer smashing the peanut rather than using your fist, because some of this is just, it's again going too far and creating a lot of hurt in areas which really aren't their constituency, which they're not going to worry about anyway. But that's going to be a very interesting time coming up as to what is going to be happening with some of these things.
We'll be keeping our eyes on it, Max and Bruce, because there's going to be a lot to write about in terms of how it affects investors and, or not just investors, just how it affects people, generally, and there'll be implications all over the place. Thanks for joining us on today's Advisor Q&A. We will be putting this up on our website online, so those of you who may have missed it, can tune in, and or those who were listening in may want to listen back to some of our questions and answers. So thanks for joining us. We'll see you again next time.